is so tight. All right. Hello, you trader nerds. Real traders never trade alone. They trade with their fellow nerds like 12547, like Carl, like DB, like Dwayne, like Edwin, like Hal, like James, like Jason, like Javier, like Jim and Corinne, like Jim, like Ken, like Lee, like Lewis, like Mikey, like Mo, like Schwaz, like Sean, like Stacy, and like Vicky. Welcome all and all. And listen, a lot of you make a lot of comments on my YouTube channel, and y'all think I don't see them. Y'all think I don't read them. I read every one of them. And the one that I read yesterday that got me is this. It said, "Oh my goodness, Bobby, do you not remember like 12 days ago?" And what they basically were saying is, "Hey, Bobby, you just like everybody else, you just jump right back into the 111s, like you don't remember the haircut that you took the other day." And I take that to heart now. And I really focused on that little comment. I thought, Bobby, do you not remember 12 days ago? Do you remember what you said that you would never go through that again? And I do remember that. I really do. And then yesterday, we just jumped right back into a 111, didn't we? So let me tell you this, whatever I do is going to be much more cautious. And I was met one-on-one with a couple of individual students yesterday, and everybody was like, listen, I am taking my time before I dip back into the water, especially when you look at our country, y'all. 50% of the population hates the other 50%, and the other 50% hates the other 50%. And everybody's just hating each other. And we've got a highly contested election, and 50% is going to be around 50% one side and 50% of the other side. And 50% are going to be happy, and 50% are going to be really pissed off at the end of the election. So where does that leave us? It leaves us in very volatile times. And I was of the opinion the other day that we are probably, I thought we'd have more movement to the downside after we had this big day here. We had a little bit of warning. You see this down move, and then it was more volume and more volume before it finally fizzled out. And then look at the volume here. Everybody was selling, nobody's buying, but nobody's selling. That's the thing. We don't have any selling pressure here. We've got buyers, but not at the amount that we had sellers over here. Look at this, these people selling. So these people that were selling here, they probably not got back in yet, right? And there's going to be sellers at some point in this market. You cannot have this little parabolic move to the upside without having a down movement. You've got to have a down movement. Hopefully we'll get a little bit today, because I'd love to sell some more puts trying to get the black swan hedge in, another tranche of that. But you just don't know when it's going to come. And we know that this is coming again. It's just a matter of time. So do we all want to jump back in and act like it didn't happen? No, I don't want to. So I take your comments very seriously. Bobby, do you not remember, I guess, Dale, it was 15 days ago, when we endured this and had to puke positions because we were seeing our net lit go to nothing and negative. And we had to. We didn't have a choice. Do I want to do that again? No, I don't want to do that again. I never want to go through that again. And I remember, and yesterday I was probably a little complacent, and I probably said, oh, let's just go back to the 111s. Let's just go back, and and maybe it's a little premature. Maybe it's premature. But I don't know what the ultimate goal is going to be. I could definitely see me running my portfolios as a doomsday portfolio. I could be Mr. Doomsday. And then we get on here every day and we'll talk about all the news and all the reasons why our country is going to kaput and all that. But I don't know. That just sounds wrong. But we do know that I think in the last 10 years, we had a VIX above 50 4 or 5 times in the last 10 years. Is it going to happen again? Yes. Is it going to happen again this year? I don't know. Let's see if we can look at VIX on this chart, see what it looks like. Let's see what VIX looks like. Yeah, are we going to have this again? I don't know. But linear regression shows, hey, VIX is upward, right? It's upward, but really the linear regression on VIX isn't worth anything. Are we going to have this again? I'm not sure. I'm not sure if we're going to have that again this year. We'll have this again at some point. What's it going to take for that to happen? What if 81-year-old Joe Biden dies in his sleep? Does that mean that the VIX goes up? I don't know. if Kamala Harris is next president of the United States, does VIX bump up? If Donald Trump is next president of the United States, does this bump up? We don't know. But we do know that at a low VIX, that there is a higher probability than not that the VIX is going to increase again. We just don't know where it's going to increase. We just have no idea where it's going to increase. So all that we can do is say that we know it's going to happen again. We just don't know when. We just don't know when. Because if you were to look back in time, I mean, look at this, y'all. I mean, here was VIX of 36. This is in 22. This is VIX of, 30 something in 2022. This is February 2022. Is this going to happen again? Oh, yeah. Is this going to happen again? This is the, probably, right? It's just a matter of time before this thing pops up its head. Do I want to be knee deep in pig manure in 111s again when that happens? Not really. Not really. But do I have the patience, right? Do I have the patience? Look at this, 2015. We saw it there. We see it in here. If I remember correctly, Stacy says ES hit a circuit breaker close to it election night of 2016. The election night of 2016, y'all, when it was determined Trump was president, the market went nutso. It was crazy down. And it recovered very, very shortly. Let's see when 2016 was. Here's 2016. This is January, February 2016. Let's see if we can go to November. Here we are, November 2016. VIX popped up, right? Looks like it got up to about, 26 or so. But keep in mind, this is VIX, and it was not open that night. VIX was not open that night, so volatility was screaming that night for sure. But the VIX futures probably did that. So this is not an uncommon thing for VIX to go boom, 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 and to really pop up. It's a matter of it happening again and again and again. It's just, do we want to have a strategy where we basically come here every day and say, hey, we're waiting on the next crash? Now, if we could be like, who was it, Mike, that, made the $200,000 in one day? Yeah, that could be nice. Could be nice. We just got to wait on that to happen. So I hear you. I hear exactly what you're saying. And I'm the same way. I'm like, I'm not sure that I'm all in on the 111s again. And if you want to be, that's fine too. We've amended the plan. We think it's as safe as we can possibly make it. But is it foolproof? No, it's not foolproof. It's not foolproof at all. So we want to look at these. Let's see if we can look at what the E-minis did on the election night last time. Kind of cool to watch these things, isn't it? So let's see, the election night of 2016. Why does it not go back further than that? Let's see, here it is. Good Lord, it's up so much that you can't even see it back in 2016. Let's see, 2016. Let's see what it did on 2016. The E-minis. Here it is, November. You see the big move down, and then look, that was a down arrow, and then that thing just cratered right back up. But there for a moment, look at that. Look at that amount of volume right there. That thing popped up for a moment, baby. Could it do it again this time? Yeah, it could. And do you want to be all in on 111s and 112s when the market does that in the election day? I'm not certain that that's where I want to be. So you got to make up your own little mind on what you want to do. But, I'm not sure that I'm all back in because I really never want to go through that again. Never want to go through that again. And it's amazing that after the market goes down, or goes up for 8 or 9 sessions, or since the last time we were down, it's like we forget what we were doing. We totally forget what was happening during that time. But at now, we see what's happening here. Let's see. Let's get this right here. Yeah, that's right. Was somebody going to say something? Ed, there's Ed. Ed, talk to us, Ed. No Ed's here. Well, I thought Ed was going to say something.
Hey, Bob.
Hey, Ed, what's your thoughts, Ed?
Well, you know, I run low notional, so my thought is always to have some exposure, but not overdo it.
Yeah.
I certainly can't argue with the general premise that, what caused this flare up. We'll debate in the future, but the Japanese carry trade unwind had a lot to do with it, and that is rebuilding. It blew out partially, and then it starts getting rebuilt again. So that could be an ongoing sort. And then, like a lot of the issues you loosely mentioned are out there. We are approaching political season. I would seriously doubt we have a 2016 type reaction no matter who wins, because the two candidates are known, and they're probably, Trump didn't have much of a chance of winning according to the markets in 2016. So it was a surprise. It wouldn't be a surprise if either candidate ran. There's both are more recognizable as potential winners, I guess is what I'm trying to say.
Mm-hmm, mm-hmm.
And so I don't know, is the market going to get surprised by that? I don't think so. Uh, Beyond that, I mean, like, how is the country going to react to the election? Will it be a peaceful transfer of power no matter who's elected? Because it's going to be a new president either way. Those type things. Now, I'm not saying go hide under a rock from that. And it's tough. It's just a very tough thing. So, I see you're in kind of a transition mode on what to do with your account going forward. I can't honestly see you continuing to just wait for the next VIX blow up, because, it could happen next week or it could happen 2 years from now. And that might be kind of tough. Um, and rates will be falling. Everyone's been feasting on interest rates, high interest rates, particularly in the short end. And those will start falling as the Fed starts to cut, like the T-bill, the 1 and 2 month T-bill, the T-bill ETFs, those rates will start falling. And the further out rates have already fallen pretty significantly. So I think the 10-year is down a full percentage point from its April peak already. So there's some anticipation of these rate cuts coming already. And so, there won't be a ton of yield opportunity there like it has been, although it'll still be, more than when rates were squashed down to zero. Beyond that, I don't really know. Any specific questions for me beyond what I just commented on?
Ed, do you really think they'll be able to start cutting rates in September?
I do. I think now when the market collapsed, the expectation before the collapse was we'll do a quarter, a quarter, a quarter at the September, November, and December meetings. And then when the market collapsed, there was pretty quick market expectations shifting to half a percent for September, November, December, or 1.5% total cut off the Fed funds. It's back to like 3 or 4. Some people were still calling for and then at that time they were calling for an emergency 50 basis point cut, like come to the rescue, Fed. Well, the Fed didn't, and the Fed shouldn't have. That would have probably created more havoc. So I do think they'll be cutting in September. My guess is a quarter. I don't think they want to look like they're panicking and worrying about the economy. I don't think they need to worry about the economy. I think the economy is relatively strong. I saw this morning that the Eurozone's inflation was still 2.6% year over year, which is still higher than they wanted. So all the people that are just screaming and dying for heavy, heavy cuts just wanted to support the market. And be careful what you wish for, because the heavy cuts usually come because there's economic weakness and the Fed needs to cut fast.
Well, and here's the thing too. Everybody is griping about the high price of things, but I'm gonna tell you something. They're still at the Lazy Donkey at the Mexican restaurant. I'm seeing them there. I mean, everybody's still at the Lazy Donkey. Don't tell me that you're upset about prices and you can't afford your rent and all this stuff. They're still spending money, Ed.
Oh, yeah.
It takes you 20 minutes to get a seat at the Lazy Donkey.
Well, and that's the other thing. A lot of people are like, oh, look at the layoffs, look at the layoffs. Well, look at the hires. So for everyone getting laid off, there might be another person or two getting hired. So there's just a shift of who's actually doing the spending.
Mm-hmm.
But I agree with you. there's always someone out there doing their thing.
All right, so VO says interest rate cut means the market will dump. They think the market will dump after interest rate cut. What's your thoughts on that, Ed?
My thought is if it's a panic reason that they're cutting rates, like the economy is soft, yeah, it could be. If they had cut rates at the meeting 2 weeks ago, that when they didn't, it kind of precipitated the market. Powell implied he would be cutting in September, and the market surged on that announcement. The day after was the Thursday before the Friday that into the Sunday night, Monday morning plunge. So we had Thursday, Friday, Sunday night, and Monday where the market was just like not happy, very, very irritated. And, for that reason, I don't know, Bobby. I don't think it's necessary. If the Fed does it gently and easily because things are softening, the market should not correct for that reason. And I know people are also saying, oh, when the yield curve uninverts, it's going to be, the market will be collapsing. Well, there's a lot of depth. We'd almost have to have a separate session on that aspect. But when the 1 and 2 month Treasury are way above the 1 year on out, the yield curve is still inverted. So as those things come down naturally, the yield curve will kind of start to uninvert. I don't see that as a reason for the market to crash like is so commonly put out there, because usually the market's crashing because the economy's soft, which is making rates plunge, if you will. But for the Fed just to cut rates from restrictive or moderately restrictive to neutral, or maybe even, less, but probably just to neutral over the next year or so, I just don't see that as a reason for the market to crash. I think a valuation issue is more in question. And then we have these external dynamics like the carry trade. And I saw someone say the carry trade is over. The carry trade is not over. As long as Japan's rates are 1% and our rates are 4 or 5%, people will sell the yen, buy dollars, and put that money into treasuries and earn that few percentage point difference. That is what a carry trade is. So as long as there's a country where people can short that currency and buy dollars, or another, like Mexico was wrapped up in this. It's very complicated, but it's done, and it's done in quantity. And I've read multiple reports where right after that thing flushed, it didn't all flush out. About a third to 30 to 40% of the carry trade flushed, from what I understand. And then I read articles where it was starting to rebuild again. So that's going to be ongoing as long as the Japanese and U.S. rates are so different. If the U.S. starts cutting and Japan allows their rates to drift a little higher, that carry trade will continue to unwind because it'll be less profitable. But that's just my opinion. The other person who posted that, they probably have a strong reason to believe that it is over. And like everything else, we all have our opinions.
Well, Ed, we sound like CNBC with your analysis. You could go on there and do this, Ed. You could do this for a living.
Well, I'm just having fun.
Oh, I like it. Jim in Korean says, if you think you know what the market will do based on various events, you will be wrong 50% of the time. Isn't that the truth?
I love that.
And Auction says Black Swan is all about not known events. And that is true. And in my research in my dissertation about Black Swan events, a Black Swan occurs more often than you would think that a Black Swan occurs. They do occur more often than you would think that they occur. A lot of people would say Black Swan happens once in a generation, but they really happen more than that.
They do, and you've heard me say that before, as your viewers have as well. If you pull up a long-term VIX chart and set it to quarterly, like on Thinkorswim, you'll see where the market, how often it spikes to 40-something or 50, and it's not once in a generation, and it's not once every 10 years. It's way more than that.
Yeah.
And when it tracks from 10, 12 or so and zips up to 45 or 50 in 3 or 4 days, that's exactly the kind of account incineration that we just saw. And I think for people to pretend, oh, we just had that Black Swan blow up, I'm good now, it's never going to happen in my, brace yourself, because it does happen more often than people think. And my awareness of that is what's kept my notional load so low with these options, because when you're over levered and that VIX screams, it's like someone putting a blowtorch under your rear end. It's gonna, make things uncomfortable. So, you work on your black swan hedge. Other people do this and that and the other, or a combination thereof. And none of it's perfect. As you know, as you can see, even a well-placed black swan hedge where everything's in place when the blow up comes, it can protect the portfolio. But if you're over levered and you don't have enough of it on, well, it's not going to work. I heard, well, I'll just mention his name, David's son at Trade Buster. He did a What Happened to Me During the Blow Up podcast. And he found to his amazement that he was actually somewhat overhedged in his theta engine component of his portfolio. And before the market opened, his account was actually up 5%. Now, he said he either couldn't or didn't get out of those positions, but he was contemplating just flattening the whole account with the market down so much and his portfolio up. But and then blah, 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 you'll have to listen. And he kind of just was very forthright about how it went. And it was very educational. So it's a matter, and I've looked at the bombshell hedge, and I mean, you need a lot of it if you're going to run a lot of shorts, and it kind of gets very bloated and heavy. And as you just experienced and so many others, Bobby, like one little false tick of a bad situation can kind of tilt that thing. So it's worthy of doing, especially if you're running higher notional exposure. Just, keep on top of it and be aware, and always remind yourself we don't know when the next thing is coming. I mean, it could be tomorrow. It could be 5 years from now. We don't know. I do know this. We've had a V recovery and we're right back to where we were. We've kind of revisited the scene of the crime, the recent all-time highs. I think we're like 1% off right now.
Yeah.
Maybe closer to 2, something like that after today's little mini drop. But look at the run we've had. It's almost a historic run up. Like 2 weeks ago, we were at a historic fast run down, and now like it's a huge V shape. So I would expect the unexpected. I don't know. Are we going to race to new highs and bump up to 6,000 now? Or are we going to drop 2 or 3 or 5% and give back some of what we just had? I don't know. But as option traders, those moves are pretty big, and beware.
I think that's well said, Ed. Well said. Well, what I do know is even though I put on a 111 yesterday, let's look at the account. Oh man, make me remember my password. We look at that and we sit there and say that let's see, this account, let's go and do the account requirement. Account requirement. Now, someone also said on the thing, they said, "Hey, wait a minute, Bob. Are you sure about these numbers here?" And I guess the best I can tell them is no, I'm not sure, but it's better than having nothing, I think. So here's my 111 that we did 2 tranches of yesterday. And so if the VIX were to go up 40 points, so we're at a VIX of about 14 or 15 now, and we had a 20% down move, I should be up $13,000. If it happened like it happened the other day and VIX went up 40 points in a day and we were only down 4%, it says I'd be up $4,000. So, this is a very, very, very protected account at the moment, even though I do have a little bit of these. So I think that's probably the better thing, Ed, is to put these in at advantageous times and not worry about them so much. Just going, hey, I'm going to do one every week until this thing shows I'm down $1 million. If VIX goes up 40%, because I never want to be there again. That's the one thing I never want to do, is be at that place again.
No, I agree.
So what I'm looking for, y'all, is I'm looking to continue to build our little wall that we have decided to build, whether I do 111s or 112s in it or not. And I am so ready for 2 red days or 1 down day of 0.4% or more. Hopefully that'll be today. We're down a little bit now. It'd be nice to get a down day of 0.4% or more where I can sell an additional 3 to start my next 3.5 hedge. But believe you me, that before I sell the 3, unlike what I did last time when I sold those 33, unbelievable, that will always haunt me for the rest of my life. We're going to make sure that we at least know what our risk is to the downside. At least what our risk is to the downside. Let's see what Mr. Big Green Monster saying here before we leave and take this day for the rest of the day. So now, interestingly enough, we are on a pivot line here, the 20% line. It's trying to figure out if it's oversold or fairly priced. That's what price is trying to do. If it's here, it's oversold. If it's here, it's fairly priced. And as Ed talked about, are we at a point to where we're going to go up, and test the highs? If we do go up, look for the next big area of resistance to be at the 56.91 based here. And how this little thing continues to do this. Look at this. I mean, it bounced off of there. It finds a little bit of resistance here. It interplays here around our 0% line. It goes up here. What is it doing? It's doing the same thing it does on these lines. And so it's trying to figure out if it's oversold or if it's fairly priced. If we stay here long, then we'll probably pop back up to that 56.91 before we find additional resistance up there, which is, I don't know how this works, Ed. I wish I did, but it works time and time again, showing us areas of support and resistance. Just amazing how this thing works. Do you use this at all, Ed, or do you still draw it?
You know, Bobby, I look at it on your video.
Yeah. Mm-hmm.
I did your Big Green Monster video, and for some reason, and you know, I'm a chart guy. I fiddle around with Thinkorswim. I can't get myself to work this thing correctly. So honestly, I just kind of fudge and look at yours when you do it.
That's fine, Ed. That's good. But
I do run Fibonacci levels in general, so I kind of run that. But this is kind of Fibonacci with a twist. So you know,
let's see if we can garner anything from the expected move since we're doing this today. This is kind of interesting. Expected move. Let's see. Here was our big drop. But look at this. Here was the amazing thing. Well, I guess we were here on the expected move. We went under that, but that big red candle there was not really that far outside of the expected move on that day. Let's see. Is this a daily chart? It is, isn't it? Let's see. Daily. Yeah, daily chart of ES. Now,
and Bobby, when I look at that preceding the big decline, like there were a couple of weeks in there where we were busting to the downside below the expected range.
Yeah, we're
so there was some
here. We busted down here. We busted down here.
I'm not saying that was a warning per se, but
3 straight weeks, Ed. We did that.
Yeah.
Look at that.
Yeah.
For 3 straight weeks. Was that a warning to that coming again? Well, look, it did it here too. Here's one time. It busted out twice. It busted out, well, in the third time. Yeah. So you get a couple of weeks warning when these things happen.
And that's the tricky part, as you and I have discussed probably 50 times. Like when we're having this April correction, this garden variety type correction, where everything gets all stretched, our metrics are stretched, and our buying power goes up, and it might get a little scary, or might even be an opportunity to put new risk on because volatility is increasing. Is it just one of those little things, or does it accidentally slip and fall into what we just went through? And because before then this decline, it looked like the April decline, and a lot of people were saying this is just like another pullback like the April decline, and then it wasn't, you know. So again, as I said at the very beginning, we debate on whether it was the carry trade or what. The market freaked out, it broke support, it backfilled the gap that it had made from June 17th and kind of retested it from below and tried to get above, failed, and just exploded to the downside. So why it really happened, I don't know. But everyone's calling it Vomageddon 2, which I guess they're referring back to Vomageddon 1, which was the March 2023 banking crisis, where we kind of had a similar situation where the market pulled back about the same amount, but it didn't do it in 4 days. It did it over like a week and a half or two. So it was kind of a stretched out rip to the downside for volatility and option prices.
And Ed, I'm going to
Spike
tell you something.
higher.
In this area, I had never heard of the carry trade. I didn't hear the carry
Okay.
trade till it was too dang late.
Well, the carry trade's been going on for a long, 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 long time. So because the yen has been low, they had negative interest rates for a while. Even when our rates are zero, their rates were negative. And I mean negative, like I think negative 1.5 or 1% on the 10-year. And so you paid to put your money into a Japanese security, which I can't really totally get my head around. So people would short it. And if you look at a long-term value of the yen, it used to trade around $1 for the longest, $1, $1.10, 90 cents. And then in recent years, it's risen up to 160 or so before this big pullback, where it's, I think, in the upper 140s per dollar now. And so when you're short the yen and you're making that 3 or 4% a year difference in rates on the thing, and the security is that yen is declining in value, it's an added kicker. So big sophisticated money looks for these kind of situations. I understand more or less how they work. I'm not quite sophisticated enough, or dare I say ballsy, to do this kind of thing. So, but it's been going on largely for decades. And that's why I say it's not over until the interest rate differential fades or there's some other dynamic. Big money, hedge fund money, big private offices and individuals will continue to pile into these kind of trades because it's a decent way to earn a return and maybe a big return. And, then they all head for the exit at the same time. It's like everything else. Oh, it's all safe and the water's great until everyone wants out at the same time. So
In
anyway,
other words, by the time Mr. Retail Trader like me hears about the carry trade, it was too late.
it was too late. Yeah, it was too late.
So Stacy brings up a good question. Yes, Stacy. So the amount of additional shorts for BSH will be determined by risk analysis. Yes. Now watch this. So let's look at this account and let's look at it. Let's pretend we didn't do the 111 yesterday. Let's just say that we didn't do that. So we've got an account that has 12 and 20, right? That's 12 and 20. It's all that it's got. And let's say today we get the market move down and we say, okay, now it's time to go ahead and do additional shorts. So you would actually look also and say, well, how many days do I have on these longs here? I've got 60 days. And on the activity tab, these things are at 55 cents. I'm close to harvesting, right? I'm close to harvesting. It's not too far. But then I would say, okay, let's go in and let's trade ES. And let's say that we were going to 2, 3. Now, the other day, this brought this thing to negative. Let's see what it does today. So we're going to say, yes, let's go in and let's go 60 days or more. So we go to 72 days. And we go down to the one that's going to be around $3 or so. So that's the 36.50. And we're going to sell 3 of those. Okay. So we go back to count requirement. And what we'll do is we'll say add order legs here. Everybody see that? Now when I bring in those order legs, you see that I'm no longer at assuming we go at 40%, I'm no longer protected on those 3. Ouch. Now, if I had harvested these, we're protected again. Everybody see that. But we're not at harvest yet. So, it's kind of a catch-22. What could you do? Well, you could go in and you could say, well, I'm going to harvest these at 55 cents or 50 cents instead of the 20 cents, get rid of those. That way I'm fully hedged. Then you could say, to make up for those being gone early, then you could say, could I do 6 of those? Could I do 6 of those? 5, 6. No, you couldn't do 6 of those and be fully protected. So we break that back to 3, right? Where you're fully protected. So this needs to, in some way, figure into your decision on whether to add things. Now, what we talked about is maybe this. Maybe you could say, hey, let's click those again. Maybe you say, I can diagonalize that thing, which some people have been talking about. So we say 36.10 36.50. What if we went to 72? Let's go to 42 days or 41 days. And if you were to buy the ones that cost $1.50 or so, $1.50, let's just look at that. You're saying the 38.50s. If you buy 5 of those, let's move those up to 5. Let's see if it'll analyze this across. This will be interesting to see if it does this or not. So that way you do 3, 5, and you're doing that for an overall credit. What does that look like? Let's bring it back up. Let's see if it's able to analyze this. So this should make it a little bit better, but it's not going to show that, is it? Hold on a second. Let me take order legs off, put order legs back on. It's not showing the 3 negative, is it? It's just showing the 5. It's not going to show you. That's a darn thing. They need to fix this so we can actually see what the 3 and the 5 would do. I guess we could take it and look at the 3 and what it does, and then the 5 what it does, and then come up with the combined trade. But it doesn't look like that's going to do that. But it would definitely do it after you put the trade on. So that's something that I would probably do. Is diagonalize it there so that you do have some longs on, and you're able to do that at a break even or a small credit. So in this case, we do 260. Will it even let you do this trade? Let's see if it would let you do it. I guess so. They'll let you do it across things. That's kind of interesting now that they'll do that. So you'd be getting a credit of $103. And you could even say, well, I'll make it even stronger. I'll move that up to 3,900. And what was our shorts? Was it 36.50 or so? Your longs are at 39.50. Yeah. Yeah. And still do that for a credit. So there's all different kind of things that we can do here. So anyway, well, great session today, Ed. Thank you for your knowledge. We appreciate it so very much. That was great.
Thank you, Bobby.
We need
Thank
to
you.
have you on more regularly, Ed, to talk about the markets and all this
Look
stuff.
for the red dot. I try to look for the red dot.
Okay. Well, it sounds good, Ed. We love it. And appreciate all of y'all. Love you to pieces. Y'all have a good day, and I will see y'all tomorrow.